Hi, my name is Garrett Monroe. I'm the sell-side director here at Calder Capital. Thanks for joining me for a year-end recap of 2024. I wanted to talk about two main things that happened on the sell side in 2024 for Calder. One of them was closing deals, and I'll give you a couple tidbits and facts on what we experienced in 24. Then I wanted to talk a little bit about the team and some of the additions that we did on the sell side in anticipation for 2025 and what we think is going to be an uptick in deal flow. 2024, Calder ended the year with 46 total transactions. Of the 46, 42 of them were sell-side deals. Along with closing deals, we added 3 analysts and associates on the sell side to make sure that we can continue to get through valuations, SIMs, marketing materials in an effective and efficient way. We also added 5 new locations to Calder's outreach, one in Lansing, Michigan, one in Nashville, Tennessee, one in Philadelphia, Pennsylvania, one in Tampa Bay, Florida, and then we also added another advisor on the buy side that's going to do buy side and sell side work. In 2024, we conducted 125 valuations compared to 2023 when we only conducted 115 valuations. We definitely saw an uptick in third-party valuations, and we also got the sense that a lot of business owners were starting to get out in front of getting their company valued and starting the process 2 or 3 years before they actually are thinking about selling, getting a pulse. A lot of them want to get a pulse during an election year to anticipate, depending on where the election fell, different policy changes, different tax changes, when they ultimately wanted to sell their business. So we're excited to see if 25 brings an uptick. Maybe we'll see 130, 135. At least that's what our goal is. But it was interesting to see the uptick in valuations 24 versus 23. Comparatively to valuations, which we saw an uptick in 2024 versus 23, we actually saw a decrease, 57 in 23 engagements or sell-side clients that engaged with Calder versus 50 that we saw in 2024. I think there's quite a few factors that came into play. We obviously saw sellers taking longer times or extended periods of time to decide if they ultimately wanted to sell their business or not when it came to timing, valuation expectations, the type of buyer that they wanted to consider. But there was a lot of factors at play in 24 versus 23. Obviously, we were just getting out of COVID and still the ramifications of inflation, price increases, supply chain issues in 23. 24 was the election year. We saw volatility in the market in general, especially with conventional lenders slowing down their approval rates, but also a lot of them shutting down completely for the back half of 2024. Interest rates started to creep down going into 2024, or excuse me, the end of 24 going into 25, but we definitely saw some volatility there. There was a less predictability when it came to underwriting on a lot of these deals because of those two factors. We also saw an election year. So there was a lot of anticipation going into the end of the year, going into 25, who was going to win the election, what type of policy changes were ultimately going to be pitched and possibly passed through going into 25. So there was a lot of change. And when we see change and we see things that could change going into a new year, typically sellers want to take a step back and observe and wait for a lot of these changes to play out in the world, both economically and then also personally. A lot of this will flow through to personal balance sheets, investment strategies, and a lot of our business owners' companies make up a majority of their net worth. So I do expect this year Q1 to be a little bit softer, but ultimately I do expect engagement agreements or sell-side clients to be higher than what we saw in 24, probably similar to 23 levels. And we're shooting for 60 sell-side clients at a minimum in 2025. In 2024, Calder as a whole decided to launch a exit planning division. You might be asking yourself, how does an exit planning division coincide or complement the sell side? Why would I be talking about that right now? A big thing that we were seeing in the past 3 or 4 years is that we were doing a lot of valuations for clients, and the value might not have been there that they were expecting. There were some things that we picked up on in the financials of the business model or in owner expectations that just wasn't quite meeting the owner's expectations to actually want to go to market. So we brainstormed as a leadership team to launch the exit planning division because a lot of owners simply are just not ready once they do their first valuation or second valuation exercise. So was there a way where in our valuation, the sole goal is not to go to market or sell the company, but let's take the top 3, 4, 5 factors that might help improve marketability, improve valuation. Let's bring them into our exit planning team, and then they can work with our exit planning team with no stress of going on the market, with no rushed timeline, and they can take their time to work on these things, better position the business, better marketability in the long term, and they can then get flipped back over to the sell side if they want to sell in 2, 3, 4, or 5 years when they're actually ready. So I'm excited to see what our exit planning division does as a standalone division, but also ultimately will help increase our chance of success with a lot of our sellers that are better ready and better positioned to sell in the marketplace. Now that we touched a little bit on valuations, sell-side engagements, let's talk a little bit about the transactions that we ultimately closed in 2024. Out of the 46 transactions, 42 of those transactions were sell-side deals for Calder, roughly about 92% of the firm's total transactions. In 2024, our top 3 industries that we usually see come up held true in 2024 yet again. The top one being manufacturing for us. We had about 15 deals, or roughly about 36% of transactions. We had 8 business services deals, and then we had 8 construction transactions, which ultimately were about 19% of our deal flow. Curious to see where this trend goes in 2025. We are seeing more and more business services transactions that are healthy, strong cash flow, benefited from a lot of the trends that we saw from COVID. A lot of our asset-heavy deals, which would fall in the manufacturing, distribution, construction, there's definitely still stronger deals out there, but a lot of them with the interest rate volatility, price fluctuations, economic conditions, we are seeing more and more turnaround and distressed transactions in the manufacturing and construction space. So I do think that we could see some steady deals in those areas as well. But ultimately, I think we're going to see greater dissemination between fantastic cash flow positive deals and then turnaround distressed deals that are going to be looking at asset deals. In 2024, the buyer pool for a lot of our sell-side transactions, we were seeing many different types of buyers. So we saw private equity, we saw family office, we saw strategics, we saw individual owner operators. As many know, the lending, especially the conventional lending environment, was soft for the greater part of 2024. So a lot of private equity preferred to stay on the sidelines since a lot of their conventional lenders were simply not lending or being aggressive on deals. So a lot of private equity strategy turned to using cash or doing add-on acquisitions for smaller deals in the marketplace. So let's call it sub $25 million of enterprise value deals for a lot of their platform acquisitions. In 25, we do expect private equity and family office deals to come back strong, whether it's with dry powder that a lot of these private equity firms have been conservatively saving on their end, or we have seen an influx of individual owner operators, whether it's individuals, partners, independent sponsors, search fund deals, again, in that $1 to $25 million of enterprise value space where they're tapping into SBA financing or some conventional routes and ultimately becoming the active owners of a lot of these businesses. So Interesting to see what private equity and family offices are ultimately going to do in 2025. I do expect them to be more aggressive, which will benefit the sell-side marketplace or sellers that are looking to enter the market. I do expect individuals to be strong again in 25. But then strategics are always a steady source of buyers for a lot of our sell-side transactions, although those tend to be a little bit more selective, one-off transactions in nature. So we're excited for a robust marketplace. I would say more robust than 24 and 23 in 25. To sum it up, 24 was another strong year for Calder, despite a lot of challenges in the world, in an election year, in interest rate volatility, economic fluctuations. I do expect 25 to start the year slow as we start to see some of these policy changes from the Trump administration either getting approved or not. I do think a lot of buyers are going to be on the sidelines in Q1. It gives sellers a very good time to plan, get taxes done, start the valuation process to at least get an idea of what valuations could look like in 25. I do expect after Q1 of 25, once tax season is done, I do think once those policy changes are starting to go through, conventional lenders will be more active again. Private equity will become more aggressive. Individual owner-operators will be looking for smaller businesses as well. So 25, I do expect our sell-side clients to increase. I also expect us to get more transactions done in 2025 because of these factors. So I'm excited to see how it all plays out. Please do not hesitate to reach out to anyone on our sell-side team. Specifically, I'm happy to be available, answer any question, whether it's about sellers, buyers, the marketplace, even the update that I gave today. You can reach me on my email, garrett@caldergr.com, or my cell phone, 586-350-6619. We'll talk to you soon.